Right now, at this exact moment, there's a tax window open for retirees in America that has never existed before in the history of this country, and the clock on it is already ticking. It closes permanently on December 31st, 2028, and after that date, it is gone forever. No extensions, no second chances. If you have a traditional IRA, what I am about to share with you could be one of the most important financial conversations you have this year. So stay with me, because by the end of this video, you're going to understand exactly what this window is, what's hiding inside it that most people don't see, and the 7 specific steps you need to take before it closes. And here's the part that keeps me up at night. Most retirees who qualify for this opportunity have no idea it even exists. Not because they aren't smart, they absolutely are, but because the legislation that created it was buried inside a massive tax bill signed into law on July 4th, 2025, and the headlines moved on before anyone had time to really dig into what it meant for people like you and me. So let's slow down, let's talk about this the right way, and let's make sure you're not one of the people who looks back in 2029 and says, I wish someone had told me. Before we get into the details, if you are new to this channel, welcome. Hit that subscribe button right now, because every single week we put out content specifically for retirees and people approaching retirement who want to make smarter decisions with their money. No fluff, no gimmicks, just real strategy. Now let's get into it. The law at the center of all this is called the One Big Beautiful Bill Act. It was signed by President Trump on July 4th, 2025, and it made permanent most of the lower tax rates that had been in place since the Tax Cuts and Jobs Act of 2017. That permanence alone is significant for Roth conversion planning, but buried inside this law is something even more specific for seniors, a brand new provision called the Senior Bonus Deduction. Here's what it does. Starting with a 2025 tax year and running through 2028, if you are 65 or older, you get an additional $6,000 deduction off your taxable income. And if you are married filing jointly and both spouses are 65 or older, that doubles you get $12,000 in extra deductions, stacked right on top of the standard deduction you already receive. The standard deduction for married seniors in 2025 is already over $31,000. So when you add the $12,000 senior bonus on top of that, a qualifying couple could reduce their taxable income by more than $46,000 in total deductions. That is a meaningful cushion that simply did not exist 2 years ago. Now here is where Roth conversions come into the picture. When you convert money from a traditional IRA to a Roth IRA, the amount you convert gets added to your taxable income for that year. Normally, that means you're paying tax on every dollar you move over. But with a senior bonus deduction acting as an extra buffer in your favor, you have more room to convert before you hit higher tax brackets. For qualifying couples under certain income thresholds, the math can work out so beautifully that up to $12,000 could be converted from a traditional IRA to a Roth with zero added federal tax, because the deduction perfectly offsets the conversion income. That is not a typo. Zero. And for anyone converting larger amounts, the deduction still reduces what you owe, making the cost of conversion meaningfully lower during this 4-year window. Why does any of this matter? Because a Roth IRA plays by completely different rules than a traditional IRA. The money inside a Roth grows tax-free. When you take money out in retirement, it is tax-free. And when your children or grandchildren inherit it, they receive it tax-free too. Compare that to a traditional IRA, where every single dollar you pull out is taxed as ordinary income at whatever your rate happens to be at the time. And here's the brutal reality of traditional IRAs that most people don't fully reckon with until they're already in the middle of it. Once you turn 73 years old, the IRS requires you to start pulling money out of your traditional IRA every single year. These are called required minimum distributions, or RMDs. You do not get to choose whether to take them. You do not get to reinvest them back into the IRA. You pull them out, you pay taxes on them, and that's that. And the older you get, the larger those required distributions become. Your account balance grows, the distribution percentage increases, and the tax bill that comes with it grows right alongside it. There is no finish line. It just keeps going, year after year, for as long as the money is in there. And here's the thing nobody tells you clearly. If you pass away with a large traditional IRA balance, your heirs inherit the tax burden too. Under current law, most non-spouse beneficiaries have to fully empty an inherited IRA within 10 years, which can push them into the highest tax brackets right in the middle of their peak earning years. That is not a gift. That is a tax problem wrapped in a bow. So when you understand all of that, the taxes on every withdrawal, the forced distributions, the tax time bomb for your heirs, you start to see why converting traditional IRA funds to a Roth during this 4-year window is such a compelling strategy. You pay the tax once, at today's rates, and you're done. The money works for you, tax-free from that point forward. Now, I want to walk you through 3 real-life scenarios. I'll call them Dorothy, Robert, and Carol, and James. because each one illustrates a very different mistake that can turn this golden opportunity into an expensive lesson. And I want to be honest with you. These are the kinds of mistakes that happen all the time to smart, well-intentioned people who just didn't have all the information. So pay attention, because one of these stories might sound a lot like your own situation. Let's start with Dorothy. Dorothy is 68, single, and lives in Arizona. She has a traditional IRA worth $420,000. She doesn't have a pension. Her Social Security check is about $22,000 a year, and she's been living mostly off savings since she retired at 64. Her income in a normal year is relatively modest, right around $32,000 total. Dorothy heard about Roth conversions from a neighbor and thought, this is perfect for me. So in January of 2025, she called her brokerage and converted $60,000 from her traditional IRA into a Roth. She figured she'd be fine. She'd claim the $6,000 Senior Bonus Deduction. Her income wasn't that high, and she'd come out ahead. What Dorothy didn't account for was the Senior Bonus phase out. The full deduction is available to single filers only up to $75,000 in modified adjusted gross income. Once your income crosses that line, the deduction starts shrinking. And by the time your income reaches $175,000, the deduction is gone completely. When Dorothy added $60,000 in conversion income to her $32,000 in normal income, her total MEGI jumped to $92,000, well into the phase-out zone. Instead of getting the full $6,000 deduction, she only received a partial benefit. And here's the real sting. Every dollar of conversion income in the phase-out range is being taxed at a higher effective rate. Because it's doing two things at once, it's adding directly to your taxable income, and it's chipping away at a deduction you thought you had. Financial planners call this a phantom marginal tax rate. The combined effect makes your real tax cost significantly higher than your bracket rate would suggest. Dorothy's conversion was not a disaster, but it cost her more than it needed to. The smarter move would have been to convert only up to the start of the phase-out threshold $75,000 in MEGI and capture the full $6,000 deduction before it started eroding. Or to work with a tax professional who could model the exact break-even point. The lesson Dorothy learned: bigger conversions are not always better. Know where the phase-out cliff is and keep your income below it if capturing that full deduction matters to your plan. Now let's meet Robert and Carol. They are both 69, married, and living in Florida. Robert has a traditional IRA with $650,000. Carol has a smaller IRA with about $90,000. Together, their typical annual income pension, Social Security, and investment returns runs around $200,000. They are comfortable, they are on Medicare, and their Medicare premiums are based on their income. Robert had been reading about the Roth conversion opportunity and decided he wanted to move aggressively. He and Carol sat down in October and converted an additional $120,000 from their traditional IRAs to Roth accounts before year-end. They thought they were being smart and proactive, and in some ways they were, but they made one critical mistake. They forgot about IRMA, the income-related monthly adjustment amount, which is the Medicare surcharge that kicks in when your income exceeds certain thresholds. Here is how IRMA works, and this is vitally important. Medicare looks at your income from 2 years ago to determine your premium surcharges. So your 2025 income affects your Medicare premiums in 2027, and IRMA is not a gentle slope, it is a cliff. In 2026, the threshold for married couples filing jointly is $218,000. Once your income crosses that line by even $1, your combined Medicare Part B and Part D premiums jump by over $2,000 a year for the couple immediately. Robert and Carol's typical income was around $200,000, which kept them safely below the threshold. But adding $120,000 in conversion income blew right through it and landed them in a higher IRMA tier. Their Medicare premiums increased substantially for an entire year, a year they cannot get back. And because IRMA uses that 2-year look back, the damage is done before you even know what happened. By the time you get the letter from Social Security telling you that your premiums are going up, the income that caused it is already 2 years in the rearview mirror. The fix is not complicated, but it requires planning before you convert. You need to know exactly what your projected MEGI will be. You need to know where the RMA cliffs land for your filing status, and you need to keep your conversion income comfortably below those thresholds. In 2026, those thresholds for married couples are at $218,000, $274,000, $348,000, $410,000, and above $500,000 for the highest tier. Each crossing costs you more. Stay below the nearest cliff, or be intentional about it if you choose to cross, because crossing accidentally costs just as much as crossing on purpose. Now let's talk about James. James is 71, married to Diane, who is 69. They both collect Social Security. James receives $28,000 a year in Social Security benefits, and Diane receives $19,000. Together, that's $47,000 a year in Social Security income. James also has a traditional IRA worth $380,000, and together they have about $38,000 in other income bank interest, a small pension, dividend income. Their total income before any conversion is around $75,000 a year. James and Diane felt comfortable doing a Roth conversion. Their income was modest. The Senior Bonus Deduction gave them a nice cushion, and they hadn't bumped into any RMA issues before. So they converted $40,000 from James's traditional IRA to a Roth IRA. What James did not fully understand was the Social Security torpedo. Here's how it works. Social Security benefits are taxed based on what the IRS calls your combined income, which is your adjusted gross income, plus any tax-exempt interest, plus 50% of your Social Security benefits. For married couples filing jointly, if that combined income number stays below $32,000, none of your Social Security benefits are taxed. If it's between $32,000 and $44,000, up to 50% of your benefits can be taxed. If it goes above $44,000, which is where most middle-income retirees already are, up to 85% of your benefits become taxable. Those thresholds, by the way, have not been adjusted for inflation since 1993, not once. Every year as Social Security gives out cost of living increases, more retirees get pushed over those frozen lines. And here is the torpedo part. When James's Roth conversion added $40,000 to his income, it didn't just add $40,000 to his taxable income. Because he was already in the 85% phase-in zone, every additional dollar of conversion income also dragged 85 cents of Social Security benefits into taxable territory right along with it. That means for every $1 James converted, he was effectively being taxed on $1.85. If James is in the 12% federal bracket, his real effective marginal rate on that conversion wasn't 12%. It was closer to 22% because of the torpedo effect. The math is unforgiving, and it catches people off guard because they look at their bracket and think that's their rate, when in reality the Social Security torpedo is silently inflating it in the background. The smart move for James and Diane would have been to model their conversion against the Social Security formula before pulling the trigger to figure out exactly how much of their benefits were already being taxed, and to find the conversion size that didn't make things significantly worse. Sometimes the right answer is a smaller conversion. Sometimes it's timing a larger conversion to a year when their other income is lower, but you can't make that call without knowing the numbers first. 3 different people, 3 different traps. Dorothy lost part of her Senior Bonus Deduction. Robert and Carol triggered a Medicare surcharge that will cost them for a full year. James unknowingly lit the Social Security torpedo and paid a much higher effective rate than he expected. None of them made reckless decisions. They just didn't have a complete picture. So now you know what can go wrong. Let me give you what can go right. The 7-step action plan for using this window wisely. Step 1 is to calculate your actual baseline income. Before you think about any conversion amount, you need to know exactly where you stand today. Add up every income source for the year, Social Security, pension, investment dividends, and interest, any part-time income, and any required minimum distributions you are already obligated to take. This is your starting Maggie. Write it down. Everything else in this plan builds on that number. Step 2 is to identify your 3 critical thresholds. You have 3 lines you need to track, and crossing any of them unexpectedly costs you money. First is the senior bonus phase-out. For single filers, it begins at $75,000 MAG. And for married couples filing jointly, it begins at $150,000. The full deduction disappears at $175,000 for singles and $250,000 for couples. Second is the RMA cliff. In 2026, the first Medicare surcharge tier kicks in at $109,000 for single filers and $218,000 for married couples. The third is the Social Security torpedo zone. The 85% taxability threshold sits at $34,000 in combined income for single filers and $44,000 for married couples. Know exactly where each of these lines sits relative to your baseline income and know how much room you have before each one. Step 3 is to decide on your conversion target. This is where you choose how much to convert, and it should be driven by the math you've just done in steps 1 and 2. In most cases, the right strategy is a partial conversion one that moves you closer to a bracket ceiling or threshold without crossing the wrong line. Many financial planners recommend targeting the top of the 12% or 22% federal bracket as a guide because those brackets represent favorable rates relative to what tax rates could look like in the future. The goal is to pay tax today at a known manageable rate, rather than face forced distributions at potentially higher rates later. Step 4 is to sequence your conversions across the full 4 years. This is arguably the most powerful part of the strategy, and it's the part that most people skip because they think of Roth conversions as a one-time event. The window is open through 2028, that's 4 tax years. If your situation allows it, spreading your conversions across multiple years can help you stay below the dangerous thresholds in each individual year, while still moving a substantial amount into Roth over time. A couple converting $35,000 to $40,000 per year across 4 years moves $140,000 to $160,000 to tax-free without triggering a Medicare surcharge, without losing the Senior Bonus Deduction, and without blowing up their Social Security calculation. Step 5 is to pay the taxes from outside the IRA. This one matters a lot. When you do a Roth conversion, the IRS expects you to pay the resulting tax bill. A common and costly mistake is to withhold that tax money directly from the IRA itself, meaning you convert, say, $50,000, but you have this custodian hold back $10,000 for taxes, and only $60,000 actually lands in the Roth. When you pay taxes from the IRA, you're shrinking the amount that gets to grow tax-free. If you have cash savings, taxable accounts, or any other outside funds you can use to cover that tax bill, use them. Every dollar that stays inside the Roth is a dollar that compounds for you and your family, completely tax-free for decades to come. Step 6 is to verify your conversion on Form 8606. This is the IRS form where Roth conversions are officially reported. Form 8606 is how the IRS tracks the basis in your IRA, meaning how much of your money has already been taxed, and it is the document that protects you from being taxed twice on the same dollars. If you have ever made non-deductible contributions to a traditional IRA, Form 8606 is especially critical. Do not let this slip through the cracks. Confirm with your tax preparer that it is filed correctly the year you convert. Step 7 is to work with a qualified tax professional or fee-only financial planner who can model your specific numbers. The interactions between the senior bonus phase-out, IRMA, Social Security taxability, your federal bracket, and any state taxes you owe are genuinely complex. Running these numbers by hand without professional tools is how Dorothy, Robert, and James ended up in the situations they did. The cost of a 1-hour planning session with a competent advisor is a fraction of what an unplanned conversion can cost you in taxes and Medicare premiums. Use the resource. It is worth it. Let me step back and give you the bigger picture because I want you to understand why all of this work is worth doing. Right now in 2026, the federal tax brackets established by the One Big Beautiful Bill Act are the lowest they have been structured in a long time, and they are now permanent. Future tax rates are genuinely uncertain. The national debt continues to grow. Government spending programs are enormous. Historically, when governments need revenue, tax rates go up. If you believe, as many economists and planners do, that tax rates in the future could be higher than they are today, then paying tax now and shielding your retirement savings in a Roth is one of the most rational financial moves available to you. Add to that the permanent elimination of required minimum distributions from Roth IRAs during your lifetime, and the benefit becomes even clearer. When your money is in a Roth, the IRS cannot force you to take distributions. You control the timing. You pull money out when you want it, not when the government tells you to take it. That flexibility is worth real money, especially in years when you might need to manage your income carefully for Medicare purposes or estate planning goals. And your heirs. Think about the legacy you are building. A traditional IRA passed to your children is a taxable inheritance that forces distributions over 10 years, often right in the peak earning years of their careers, when their tax rate could be 32% or higher. A Roth IRA passed to those same children is tax-free money that grows tax-free and can be distributed over their lifetimes. The difference in after-tax wealth between those two outcomes is not a rounding error. It can be hundreds of thousands of dollars. This is the window. It opened in 2025. It closes on December 34, 2028. And every day you wait is a day of potential compounding you're leaving on the table. Now, I want to be honest with you, because this channel is about giving you real information, not just enthusiasm. Roth conversions are not the right move for everyone. If you are already in a very high tax bracket today and expect to be in a much lower bracket in retirement, the math might not work in your favor. If your IRA balance is small and your RMDs will be modest, the urgency is lower. And if converting would require you to dip into money that you genuinely need for living expenses, that changes the calculation too. The strategies that work best are the ones that fit your actual life, your income, your health, your family, your goals. What I am telling you is that this window is real. The opportunity is real. And for a very large number of retirees and near retirees in America right now, it is worth sitting down and doing the math seriously before 2028 comes and goes. Do not be Dorothy, who converted without understanding the phase-out. Do not be Robert and Carol, who triggered a Medicare surcharge that will follow them for a full year. And do not be James, who lit the Social Security torpedo without realizing it. Learn from their stories. Take the 7 steps. Get the numbers in front of a professional who can model them properly. Here's what I want you to do right now. If this video gave you something you didn't have before, a number you didn't know, a concept that clicked, a question you now know to ask, drop a comment below and tell me which of the 3 traps concerned you the most. Was it the senior bonus phase out, the IRMA cliff, the Social Security torpedo? I read every single comment on this channel, and your input genuinely shapes the videos we make next. And if you know someone, a friend, a sibling, a neighbor, a coworker who is approaching retirement, who has a traditional IRA and has never heard about this window, please share this video with them. I mean it. The difference between knowing this and not knowing it could be tens of thousands of dollars in their retirement. You sharing this video might be one of the most financially helpful things you do for someone you care about this year. Subscribe if you haven't already, because we are not done talking about this topic. Coming up, we are going to go deeper into how to coordinate a Roth conversion with qualified charitable distributions for people who are charitably inclined, a strategy that can reduce your tax burden on conversions even further by using your IRA dollars for giving before they get to your taxable bucket. That video is coming soon. You do not want to miss it. Until then, stay sharp, stay curious, and take care of your future self. I'll see you in the next one.